Hello, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 132, titled Selecting the Best in the Money Strikes for Covered Call Writing. We're going to be using a real-life example with Etsy Inc., which trades on the NASDAQ exchange under the ticker symbol ETSY. Now, why would we consider using in-the-money covered call strikes when just about everybody else is using out-of-the-money covered call strikes? Well, there are certain times, particularly in challenging market environments, where we would tend to favor in-the-money strikes, and I'm going to be explaining why. Now, also, you just may have a very low personal risk tolerance where you just sleep better at night using the defensive position of an in-the-money covered call strike. Now, the intrinsic value component of these in-the-money premiums will provide us additional downside protection and, as you will see soon, lower the break-even price points. And that will make it lower than had we used an at-the-money or out-of-the-money covered call strike. So, at-the-money and out-of-the-money have only time value components to the premium, whereas in-the-money strikes have these time value components plus the intrinsic value component, the amount that the strike price is lower than current market value. So in-the-money strikes, because it has that additional component to the premium, will lower our break-even price points much lower or just lower than at-the-money and out-of-the-money strikes. Now, the trade-off here is that had we used an out-of-the-money strike, we would also have the opportunity to generate a second income stream in the form of share appreciation from current market value up to the out-of-the-money strike. When we use in-the-money strikes, we will not have that opportunity because we are agreeing to sell our shares at a lower price than they're currently trading for. So that's the trade-off. We get greater downside protection, but eliminate any potential upside additional appreciation. But now, assuming in this particular podcast that we do want to take a defensive position to our trade, which strike do we select? How do we go about determining, because there are frequently going to be a lot of choices, which in-the-money strike is the one that we should use? So when we select an underlying security, we generally like to select one that has strong fundamentals. And as you see on this chart, for those of you watching the podcast, an uptrending moving average of Etsy Inc. as of 12/28/2020. For those of you just listening to this podcast, you will see, or I'm describing to you now, that the short-term 20-day exponential moving average is uptrending and above the longer-term 100-day exponential moving average, and the price bars are at or above the 20-day EMA. So we have a bullish price chart, but still there may be some market considerations where we want to take a defensive position. So what we do is we go to an option chain and we take a look at in-the-money call strikes. Now, in-the-money means a strike price which is lower than the current market value. On 12/28/2020, Etsy was trading at 190.43. That means we're going to evaluate strike prices lower than 190.43. For those of you watching this podcast, you will see that the 175 in-the-money strike generated a bid price of 20.80. The 170 deeper in the money strike generated a bid price of 24.35, and the 180 still in the money strike 17.85. So those are the bid prices. Now, frequently we can actually negotiate a better price, and in my material I teach how to do that. But for purposes of this podcast, we're going to assume worst case scenario, which is the published bid price. So once again, 170 generated 24.35, 175 generated 20.80, 180 generated 17.85. So here are the keys to which in the money strike to select. Number one, we must determine what our initial time value return goal range is. Now, I'm underlining the word time value, because when we sell an in the money strike, it has time value and intrinsic value. Now, for me, my time value goal for monthlies is 2% to 4% a month. So when I make my trades, my initial structuring will always have a time value return goal between 2 and 4%. Now, this will apply to out of the money, at the money, and what we're talking about in this podcast, in the money strikes. Once we establish the in the money strikes that generate the appropriate time value return based on our goal, we will then go to the next layer of evaluation. And here it is. The more defensive we want to be, the closer to 2%. So the lower the time value, the greater the intrinsic value. Intrinsic value defines our protection to the downside. So a moderate defensive position would target a 3% initial time value. Now, a minimal defensive position, but still significant, would target a 4% initial time value return goal. So again, we're staying within our range of 2 to 4%, but we're measuring which strike based on how much protection we want. If we're really nervous about the market, we'll go to the 2%. If we are a little nervous, but not that bad, we might select 3 or 4%. So let's take those stats from the option chain and feed them into the multiple tab of one of the BCI covered call writing calculators. Remember, Etsy was trading at 190.43. So we're going to put into the blue cells the 170 24.35 premium, the 175 20.80 premium, and the 180 17.85 premium. And once we plug that in, the white cells will then become populated. Now, the initial return on option or ROE for the 170 strike, the most defensive of these positions, had 2.3% initial time value return. Remember, it's for 1 month, so it's pretty significant, with downside protection of that profit of 10.7%. That's the one of these three strikes that's going to give us the greatest downside protection. Now, downside protection simply means how much a stock can decline in value and still retain the entire 2.3% initial time value return. The break-even price point for that 170 strike is 166.08. Remember, the stock is trading at 190.43. So that's quite a bit of downside protection. Now, the 175, the middle of the three strikes, that generated a 3.1% ROE, higher than the 2.3, and 8.1% downside protection, a little bit lower than the 10.7. The break-even price point, 169.63, slightly higher than the 166.08, which was the one for the strike price of 170. Now, the least defensive of these strikes, the 180 strike, generated a 4.1% 1 month return and only 5.5% downside protection of that initial time value profit. Still significant, though. Now, the break-even price point for the 180 strike is 172.58. So the break-even price points range from 166.08 to 172.58. So you have three really good choices. They all fall within our initial time value return goal range of 2 to 4%. And then we select which strike we're going to use based on the degree of downside protection that we want. Now, remember, the 2 to 4% is simply what my goal is. Yours may be different. It may be lower. It may be higher. But this will give you a framework to work with when you're determining the best in the money strikes to align with your particular personal risk tolerance along with strategy goals. Let's summarize. When selecting the best in the money covered call strikes, we have to start off by identifying what our time value return goal range is. If we don't identify that, then how the heck are we going to know which strike to select? Once we do that, then we go to the option chain and feed the information into the multiple tab of one of our BCI calculators. The most appropriate strike will align with our stated goal, the example I gave here, 2 to 4%, and reflect the degree of protection we are seeking. Max protection, moderate defensive protection, or minimal defensive protection. And we can craft our initial trade structuring based on those factors. So once we understand the factors that will go into our decision, then it becomes quite easy to make our strike selections. Now, for those of you starting out or without any products relating to covered call writing and selling cash secured puts, you very well might be interested in our BCI package, our best and most comprehensive educational package ever offered by the blue collar investor. It has 18 components to it, 6 video courses, online video courses with downloadable workbooks, 6 calculators developed by the blue collar investor and found nowhere else, 5 of our best-selling books in ebook format, and we've held the #1 slot on Amazon.com on both strategies for 15 years now. And also our 13-month annual membership, which has 200 components to it, more than that, which includes a huge educational component of over 200 training videos, along with expanded calculators and other files and resources, and the meat and potatoes of the membership, which are our 4 reports that we give to our members for eligible covered call writing candidates. Just go to our website, thebluecollarinvestor.com, and click on the BCI package link for a video detailing everything included in this package. You can also go to our website, thebluecollarinvestor.com/store, and these items can be purchased individually. Ladies and gentlemen, that ends our BCI podcast number 132, selecting the best in the money strikes for covered call writing, folks. I hope you enjoyed this presentation, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.